Practical accounting, the better way to learn.
Okay, we're at the next module here. We're still in module 2 though. So what we're going to do at 2.4, we're going to talk about the 10 basic transactions, except we're going to get a little deeper. So tell us about it, Professor.
Let's go back to our 10 basic transactions. And again, we're going to be introducing each chapter with which ones of these we're going to be using. Buy, pay, use, make, sell, collect, borrow, lend, sell ownership, and reward owners. If you understand the 10 basic transactions, you can do all the classifications. However, sometimes they occur in combinations, and sometimes they occur in reverse. So let's take a look. Let's talk about reverses first. Okay. If you buy, you get an asset and you get an account payable. But what if you return that merchandise? Well, the asset goes down, it's a minus, and the accounts payable, you get a credit on your account. Don't worry about that. So this is actually a debit on your books, but it's minus on both. Reverses are simply transactions in reverse. Similarly, if a customer returns a item for credit, your accounts receivable goes down because you're reducing it, and your sales returns and allowances, which is a deduction from sales, goes down as well. If you repay a debt, this is the opposite of borrow. Borrow, remember, cash went up and notes payable went up. So now cash goes down and notes payable goes down. Similarly, when you collect, when you've made a loan, this is the opposite of lend. Okay, so instead of cash going down and notes receivable going up, it's the opposite. When you collect, your cash goes up and your notes receivable goes down. Don't memorize these. These should be intuitive, but I'm just showing you they're the same thing backwards.
So reverse is when we reverse the function, like if we buy inventory and we have to send it back.
Right.
That would be a reverse.
It's just backwards.
So we just
switch the sign.
That's right. So.
And there is a situation which we'll cover near the end of the course where you buy back your stock, and it's the opposite of selling ownership. So your cash goes down because you're buying it back, and you put it into an account which is a negative contributed capital called treasury stock. This is really more of a reference thing, but here we go. The next one we're going to talk about is use. Remember, the use is when you consume things. Uses are the only ways that we make an expense. Okay. And there's really two ways you can create a use. One is by consuming an asset. So the one that we did for Hot Dogs R Us was use inventory. Inventory is accounted for at what you paid for it at cost. So inventory goes down. An account called cost of goods sold, which is a marvelously descriptive account, is the cost of the goods you have just sold. Or if you use supplies, supplies goes down and supplies expense goes up. If you use a long-term asset, it goes into an account called depreciation expense and comes out of an account called accumulated depreciation. Folks, you might get hit with this one. Just think of this as a negative asset account. We'll deal with that a little bit more later. The other way is if you buy a service and you can't store it, so it's immediately consumed. So if you have an electricity, you consume that right away and you set it up as an account payable when you get the bill. Same thing with a cleaning service when they leave that day and give you a bill. Same thing with your employees' time. Okay, you are using your employee's time, so it's a wages expense and wages payable. And the final use is the cost of using somebody else's money when you borrow. It's based on time, and we'll deal with this in a few chapters. It's interest payable and interest expense. Moving on. Last one. Okay, combinations. Okay. Combinations are when two basic transactions occur at the same time. Remember, buy was set up on accounts payable, and pay was get rid of the accounts payable. But what if you do buy and pay right away with cash? It's add asset minus cash. So this is really a simpler form. You don't ever get the accounts payable.
So
Typically, this is not done in business a lot. Okay, usually it's buy now, pay later, but sometimes it's buy now, pay now. Or if you buy and use, okay, that means that's the one we just did. Any expense and your accounts payable comes right away. The third one is what happens if you get 1, 2, and 3 all together. You buy a service, you pay it, and you consume right away. It goes directly to expense. There's no bill involved, and the only asset is your cash. So we do break them up because they are common transactions, but they can occur all simultaneously. Similarly, if you sell and collect your cash right now, you earned it, so you can book your revenue, you fulfill the revenue recognition, and you get your cash right away.
What happens if we only get partial payment, or we only pay part of the debt? How does that work?
If you only get partial payment, you
Yes,
just
from the customer.
You put the amount in here of the partial payment, but this is the classification.
Okay, well, how does that, what would that come under?
Depending on what account.
Okay, so maybe we're a business, we sell and we collect part of the sale, and they owe us the rest of it.
Yeah, then we'd have some cash and some accounts receivable.
Okay, but the other side,
If you have all
the revenue.
all the revenue. Okay, the final one is an important one. We call this a trigger, and it's triggered by the matching principle. We've sort of hit this a lot, but we're going to come back to it. What happens when you sell? When you get an accounts receivable, we're going to say $25, and sales or revenue of $25. However, because of the matching principle, we did this with Hot Dogs or Us, you must at the same time account for all the cost of goods sold as an expense. And this is at the sell is at price, folks. This is at cost. This is what it costs us. The difference is profit. So our inventory goes down. This is a use. So this is used by sell. This is a common one that occurs all the time. You make a sale and you immediately have the expense and the reduction of the asset. That's the end of combinations, triggers, use, and reverses. We're moving on.
Just keep moving.
You can get this Excel workbook and a whole lot more
Stuff for free at practicalaccounting.com.
See you there.